Japanese dovishness drives futures higher in the U.S. 30 minutes until the start of trading here. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, dovish signals from the Bank of Japan give fresh legs to the recovery in stocks globally. But worries remain. Disappointing earnings reports continue to pile up, with Disney and Airbnb showing weakness for the U.S. consumer. Over the next 2 hours, we're going to get the view from the C-suite as well, from Rivian CEO Scaringe, Resy CEO Pablo Rivero, and MicroStrategy's Michael Saylor. Let's take a look at where markets are trading right now. You've got futures higher by more than 1% on the S&P 500. On the NASDAQ, we're looking at a 1.4% gain. And as Sonali just pointed out to me, we're seeing treasuries almost back to 4 on the 10-year.
On the 2-year, back to 4, but the 10-year also on the rise. Certainly, we have erased a lot of the gains that we saw this week. But let's take a look at what else is erasing gains. That is Disney, showing weakness in its park business, overshadowing its streaming profits. Disney down now about 1.7% off the lows of the pre-market, but still down nonetheless. Let's flip up the board here and take a look at some other earnings from this morning. Airbnb down more than 12.6%, points to weaker demand here based on its outlook. Bookings also weaker than expected. If Airbnb continues to drop, you could see a record drop, so keep an eye on that stock. Lyft down more than 13.6%, similar issue here. Bookings and outlook missing expectations, and Rivian down another 9.3% pre-market. Second quarter revenue missed estimates, with cash burn being bigger than expected. You're not going to want to miss it. Tune in a little later with our interview with Rivian CEO coming up in just a few minutes, Matt.
Yeah, very much looking forward to that. Let's talk, though, about the markets. Goldman Sachs CEO David Solomon sees more jolts ahead as the market reorients itself. He spoke on an upcoming episode of the David Rubenstein Show, Peer-to-Peer Conversations.
I think we're going to see more volatility in the short term here. This was a pretty big, pretty meaningful correction and a big unwind of leverage, as we have discussed, in certain parts of the system. My guess is we'll see a little bit more rebalancing. But my base case is still that there's a good chance the economy is still in reasonable shape.
All right, joining us to talk about this is Brian Levitt, global market strategist at Invesco. And Brian, he spoke with David before the Bank of Japan came out and essentially offered a jawboning put, right? Saying that we're not going to raise rates anymore if markets are volatile, like now. Yeah. What do you think that means for the carry trade? Because that was at least one of the reasons that we saw the big collapse in prices on Monday.
It did seem like a big overreaction for one rate move that you probably could envision for the first time in Japan in a long while. And the reality is, anytime you get volatility in markets, it tends to be the result of policy uncertainty. Usually it's centered in the United States with the Federal Reserve. This time, the uncertainty of just how high the Bank of Japan may raise rates. I always thought it was an overreaction. This idea that after fighting deflation for a few decades, we were going to see Japan raise rates significantly was probably an overstatement. I'd say instead it was the market looking for an excuse to pull back.
Was it an overreaction, or was it just a classic deleveraging? It's interesting. I think it's fair to point out that that carry trade doesn't just exist in the yen. Some strategists pointing out this morning as well that the yuan is something to keep an eye on as well. Can you see more deleveraging ahead?
Yeah, so I agree that it's deleveraging, but it was an overreaction to assume that it was going to keep going. To think that, once that leverage was taken out, once that was covered, that the Bank of Japan was going to keep raising rates and it would no longer be a funding currency. It seemed overstated given the dynamics, given the structural position of the Japanese economy.
In terms of the U.S. economy, it seems like we're still seeing some pretty significant growth, right? At least in Q2, 2.8% is nothing to sniff at. And as Mike McKee points out to us often, the Atlanta Fed is forecasting 2.5% in Q3. Are you worried about the unemployment number?
Not worried about it. What I would suggest is we're slowing. It looks like, if you look at the leading indicators, we're below trend. It's pointing to below trend growth and slowing, but certainly not to levels that people would worry about if they were forecasting a recession. I mean, you see the unemployment rate moving up. You see things like the ISM manufacturing survey going down to 46. These are all signs of an economy slowing.
Well, in the earnings reports that we got yesterday from Airbnb or this morning from Disney, it seems like people aren't shelling out cash to go to the House of Mouse.
Look, sometimes you have to be careful what you wish for. When we were sitting here with 9.6% inflation rate, the concern was that the consumer was just not slowing down, and we were booking Airbnbs and we were going to the parks and Disney because we hadn't done anything in a few years. We had saved some money and we wanted to enjoy some experiences. So we can't have it both ways. We knew the consumer had to slow down. The question now is just how slow does the consumer get? And for the most part, the consumer is in reasonable shape. There's no reason to believe that this is a consumer that's about to crater. But that's the concern I think some people have.
2 days ago, there was a much more drastic expectation in the bond market on how fast you would see those cuts, people even calling for that intermeeting cut. And we were talking about this idea that the 2 years already flirting with 4% again. And if you see rates not come down as fast as perhaps the market would like, then how much weaker does that consumer get going into next year?
Yeah, the longer that rates are elevated, the more challenge for the consumer. So I've been saying now for a while that I wish the Federal Reserve would get out in front of this. I believe that the inflation story was way behind us. Typically, when you see inflation roll over, it doesn't spike back. It was a pandemic challenge. Right? Blame it on whoever we want. It was a pandemic challenge. So inflation was no longer the problem. The Federal Reserve should be easing. They should, and that's what the 2-year has been telling us. Now, maybe not as much today as 2 days ago, to your point, but the Fed should be easing, starting to take some of that pressure off. The good news is, though, it's not an over-levered economy.
Well, I was just going to bring that up because Sonali's worried about the embedded leverage in the economy, but it's really at the financial level, right?
All I'm
the
saying
banks. No, I think it's fair.
It was a huge moment to realize there was more leverage than we realized.
Yes, and we're still trying to measure the size of the carry trade. But in terms of the economy, mortgages, the consumer, which is obviously the biggest part, you're not worried about a real recession here, or at least a big drop.
80% of Americans have a 30-year fixed-rate mortgage. 90% of Americans have a fixed-rate mortgage of some maturity. So most Americans are not feeling it. Now, yes, credit card balances have increased. I've joked that that was all just Taylor Swift tickets last summer. But balances have increased. But if you look at servicing them as a percentage of personal income, the consumer looks fine. So, no, I'm not overly concerned about a significant deterioration in economic activity.
To that end, also, Torsten Slok over at Apollo was out with a great note this morning to the point that you've been making, that this drop or the rise in unemployment rate was due more to the rise in immigration, increasing labor supply here, rather than it was a number of job cuts really hitting the market. What does that mean for the way you read the unemployment reports moving forward?
Well, I think we say that every time, though. So we've got to be a little careful, because what you find with the unemployment rate is once it starts to move, it doesn't come back. It goes in the direction that you don't want it to go. That's what tends to happen. And so that's why I would like to see a policy response. Now, what does it all mean for investors? We just did an 8% decline. We do those almost every year, right? So 5 to 10% you recover in 3 months, right? Not a big deal. Now,
and you were already telling your clients to get defensive at the end of last month.
We were. And a couple of days of small cap rally hurt my feelings a little bit, but I'm happy we were telling people to be a little bit more defensive until we see the Fed step in, more of a normalization of the yield curve. But, if you have a recession, you're looking more like a 20% decline, and it might take a year or two to recover. So that's really what we're grappling with if we want to put it into bigger terms for investors, at least from the broad market. So this feels like a garden variety correction. Right? I would need to see credit spreads blow out far further than they are right now. I would need to see leading indicators of the economy deteriorate far more significantly to be more concerned that this becomes something more significant.
Matt will lose his mind if I start forcing credit spreads, free market.
I like
onto the
IG
show.
credit spreads. That's a very good point. Those are your canary in the coal mine, essentially.
Those are my canary. You know, they don't use canaries in coal mines anymore, if anybody was worried about it.
That's good.
We certainly need them
I
for
think
this
that's a good
market,
thing,
however.
right?
Brian, we got to leave it there. That is Brian Levitt of Invesco. Now, we have some breaking news that we want to point out to you. The Consumer Financial Protection Bureau announcing a probe on JP Morgan, Wells Fargo, and Bank of America over Zelle scams. It's a broad and nature type of probe here, according to the Wall Street Journal reporting this morning. According to people familiar with the matter, JP Morgan had disclosed that it was responding to a CFPB inquiry, and other banks are expected to disclose their contact as well, Matt.
Right. They're investigating not only those banks, but all big banks and Zelle scams. And I mean, this is their job, right? This is what the Consumer Financial Protection Bureau was set up to do. So,
and at the end of the day, you know, more people are transacting online. Zelle is a third-party service that they're using, so all banks are now being brought.
That's right, and we're looking at about $10 billion in scams in the U.S. economy alone per year. So it's become a serious problem, and it's growing quickly. I think it was $8.8 billion in the year before. So it's getting worse and worse, yeah.
Yeah, it certainly is.
All right, another quick check on futures here. They're getting better and better. You can see the S&P futures up 1.2%. The NASDAQ futures up a little bit more than 1.4%. And the small caps gaining back a little bit. They had lost almost everything from that great rotation last month. Will they add to it? Let's get a look at the stocks moving ahead of the opening bell. The individual names for that, we go to Abigail Doolittle. Abby?
Well, Matt, let's start off on a stock that is certainly helping the futures this morning, and that is Lumen Technologies. Take a look at the stock, absolutely soaring up more than 40% in the pre-market. Now, interestingly, they put up a bigger loss than expected, a small sales beat, but most important, their free cash flow forecast off the charts. Investors really liking it. It looks like AI demand is helping out this telecommunications company. Let's take a look at an earnings mover to the downside, however, and that is Super Micro Computer, right now down about 14%. There was a 25% earnings miss on very, very disappointing gross margins. There were supply chain constraints in liquid cooling, plus a large customer mix. They actually boosted the sales outlook, but investors looking past that. And then in terms of why those futures are truly higher, at least relative to the S&P 500, the NASDAQ 100, take a look at the three most valuable companies in the world, Apple, Microsoft, and NVIDIA. Actually, I don't know about NVIDIA if that's in the third spot anymore, but in any case, big tech is making a comeback. I would point out, though, that, Matt, Apple lagging, that is the key stock to take a look at here in the days ahead to see whether or not the pullback has abated.
All right, you've been keeping your eye on Apple. We'll continue to watch that as well. Just above $200 right now. Abigail Doolittle, thanks very much for that. Coming up, Rivian's second quarter missed estimates slightly. I mean, we're talking about $1.16 billion in revenue instead of $1.17 billion.
Market doesn't like it, though.
In revenue, but the market doesn't like it. Maybe the cash burn is worse than expected. We'll talk to the CEO, RJ Scaringe, next. This is Bloomberg. Let's get to high interest now. A look at what's making headlines around the world. Bangladesh's president and security chiefs met the demand of student leaders on Tuesday to name Nobel laureate Muhammad Yunus as the country's transitional leader after mass protests led to the resignation of the country's prime minister earlier this week. The high-profile intellectual previously pioneered microloans to fight poverty. We'll be watching him closely. Vice President Kamala Harris is stepping up her efforts to bring rank-and-file union members in swing states back to the Democratic fold. She's being joined by her newly named running mate, Minnesota Governor Tim Walz, at rallies in Michigan and Wisconsin. And United Auto Workers President Shawn Fain is expected to join in Detroit as well. And more than 24 packages of cocaine were found on a Florida beach, according to U.S. Border Patrol. That's because Hurricane Debbie's strong winds swept them there from somewhere. Sustained gusts of 74 miles per hour blew 25 packages onto the Florida Keys, where they were discovered by a Good Samaritan who handed them back to the police. Now, we are watching Rivian stock this morning. It is down pre-market after the EV maker's second quarter revenue missed analyst estimates by just a tiny hair. Cash burn for the quarter, though, also came in bigger than expected. And this is the worry with Rivian. Joining us now is the founder and CEO, Scaringe, as well as Bloomberg Technology co-host Ed Ludlow, who covers the EV market so closely. RJ, I want to ask you just quickly about the sales. This is no doubt a hot product. I mean, I have been fascinated by the car. I love the design, looking at it for years, and people wait in line to get them for a long time. Why are sales only growing 3.3%?
Yeah, I mean, it's great. As you said, it's great to see the reaction to the products. And we see that both through the excitement of our customers directly, but there's lots of ways to measure this. And we just had J.D. Power does an annual appeal study. We came out as the #1 brand this year. We had a #1 ranking on a J.D. Power study last year. So the reaction to the product's been great. We've in the second quarter, we went through a big refresh to the product where we've now launched what we call Generation 2 of that vehicle, of the R1T and the R1S, where we made significant improvements in the product, but also took a tremendous amount of cost out of the vehicle.
RJ, the kind of summary of the earnings print was that all of the guidance previously issued was reiterated, and there's a lot of positivity around that. Very simply, loads of people asked me to ask you, can you define what modest gross profit means, or what you're defining it by in order to achieve it?
Yeah. I mean, ultimately, this has been the central focus for us as a company, as a business, is driving cost efficiencies into everything that we do, into our bill of materials, into how we operate and run our plant, and ultimately driving towards getting our production of our R1T and R1S to positive gross margin, ultimately to have the business get to positive free cash flow and profitability. So there's a whole series of steps we're making along the way in terms of improving costs, but the biggest singular step that we've made is what we did in the second quarter. We took the plant down for about a month. Well, we made meaningful changes to the operations, and importantly, changed a significant portion of our supply base out to new suppliers in conjunction with a number of design improvements. And all of that comes together to take us to a place where the incremental contribution of every vehicle we sell is positive, and that's that's what we're driving towards. That's where we continue to guide towards for the fourth quarter of this year.
In the first instance, oh, sorry, Matt, I was just going to hold RJ to account on that one and say, in the first instance, is it just like more than zero, or single digits gross profit? Just, I think that's the answer we're looking for.
Yeah, we haven't provided a specific number, but certainly by saying it's positive gross margin, it's more than zero. Our objective, what we've guided to for a long time, we continue to maintain this guidance, is the long-term margin profile on R1 should be around 25%. And so that's what we, beyond just this fourth quarter performance that we're tracking towards, seeing how we continue to improve in 2025 and beyond, we still maintain confidence in the 25% gross margin.
And the gross profit on vehicles has nothing to do with the credits, but with credits you can make a lot of money, as we've seen in the case of Tesla. You're making double-digit millions there. Do you expect that to grow considerably? Is it really part of your financial planning?
Yeah, I think as we design the business and think about how we're operating the company, the credits environment is certainly something that's a helpful tailwind, but we don't design the company or the business or a strategy around it. It is worth noting, though, that we're seeing the credits environment really become a lot stronger as a number of existing or legacy manufacturers dial back or walk back from their electrification strategies. And we see that as further, I mean, the most important point here is it further amplifies the need for more product in the marketplace. There's very, very little choice in the sub $50,000 price range. And we see that, with just the dominant market share position that Tesla has with its Model 3 and its Model Y. Customers need choice. And so this is why we're so excited about the R2 program, because we think there's a tremendous amount of latent demand that wants to buy a vehicle a lot like an R2, wants something that's less than $50,000. Okay. In that product when it comes to market. It hopefully answers that need.
RJ, for most of the time that you and I have known each other and we've talked, Rivian has been in a position where it's been supply constrained. I wonder if that's still the case on the R1 refresh. You know, you talked last night as a big factor towards gross profit being ASP essentially, that these higher performance spec R1s are going to put you in a wider range of price points, but that will be a contributing factor. Is there a backlog essentially for R1? Are you supply constrained in that sense?
I mean, it's an important point. We've with the relaunch of what we call the Gen 2 R1, it's not just cost out. We've also added some new packages. We have a tri-motor, our new next generation quad motor is extremely high performance. That's allowed us to stretch the pricing band from our base, roughly $70,000 vehicle up to over $100,000 for our quad motor. And what that's really helpful in doing is helping to drive continual, sort of maintenance of that high average selling price. So this is something that we also continue to have confidence in. It does reflect, as you pointed out, that there's a backlog of interest and excitement around the product. And today, one of the things we're focused on is making sure that the tri-motor and the quad motor ramp meets customer demand. Those are the higher price variants. They're great for driving ASP. They're also the products that a lot of our early adopter customers really want to get. They want the best version of the vehicle that we make.
I want a quad motor. Over 1,000 horsepower with this vehicle. I think it starts at around 100 grand if I want the highest trim level, RJ. I would have to borrow money to buy that. How important is it for you that the Fed bring rates down into the next year?
I mean, ultimately, we watch this extremely closely, and just the overall macro environment that we're in, an interest rate environment, it does have an impact on folks that are buying vehicles that are of this price point, $80,000, $90,000, $100,000 vehicles. It's hard for us to predict exactly how that's going to play out. We, much like in the credits environment, we work really hard to make sure that our business is not dependent upon ultra low rates, but it certainly affects anybody who's selling products that have financing associated with them.
RJ, you gave really early heads up to investors that you're going to shut down normal for about a month for splicing the plant, right? Accommodate for R2 install. That's a long period of time. Thinking back to April, the 3 weeks, I know you're not going to tell me a number for production for 2025, but could you extrapolate out whether it's higher or lower than the base of 57,000, given that 4-week period you outlined?
The decision to put R2 in normal was one that's going to ultimately provide us around $2.25 billion of capital savings in terms of reduce the amount of capital necessary to launch R2. So that was one of the big drivers. The other is it allows us to have really high fixed cost absorption between R2, R1, and our commercial vans in a single plant. Now, of course, to do that, it does require us, as you said, to shut down the plant for a period of time. What we've provided guidance on is to say in the second half of 2025, we'll be shutting down the plant for about a month. And that will impact production. We've guided to say 2025 will grow relative to 2024. We haven't been overly specific around the exact numbers of vehicles we'll produce, but it will be another year of growth for us.
RJ, when I was a kid, some of the cooler guys had a Scout International truck in the high school parking lot. I always thought they looked so cool. And Volkswagen is reviving that brand. You're working closely with Volkswagen. My immediate thought when I saw that story was, wow, they could just take a Rivian and rebody it as their new Scout. Is that anywhere near part of the plan, or what kind of vehicles can you build together with VW?
Yeah, the Volkswagen partnership is something we're really excited about, but the focus of this is around leveraging our network architecture, our topology of computers, topology of electronic control units, the ECUs in the vehicle, and then, of course, our software stack. It does open the door to other types of partnership and activities we could be doing with Volkswagen Group, but to date, the core focus, the singular focus is around our software and electronics technology.
All right. Well, we look forward to any news that comes out on that. RJ, thanks so much for joining us. Really appreciate your time today. RJ Scaringe there of Rivian, as well as Bloomberg Technologies anchor Ed Ludlow, who also is essentially the EV reporter for us here across all of our platforms. This is Bloomberg Open Interest. A quick check on futures shows that we continue to see more than 1% gains, pretty much the same as it looked 10 minutes ago. The market open in 3 minutes' time. We'll talk to Nancy Tengler of Laffer Tengler Investments today as well on what she expects the market to do. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at where futures are trading. Right now, more than 1%, 1.2% on the S&P. This has been pretty steady for the last at least half hour, 1.5% on NASDAQ futures. So the rebound essentially continues, even with jumps like this and yesterday's 1% gain. We still haven't made back all of the 3% to 4% losses that we saw on Monday, and especially if you put them together with Friday. But it's better than a stick in the eye, as my first stockbroker used to say. You can hear the New York Stock Exchange bell there rung by Abbott down here on the NASDAQ. You have Hellport AI ringing the bell. A quick check on the major averages as we get into the swing of things today, and you see, sorry, let me move this way. You see essentially what you saw in futures, 1.1% gain on the S&P 500. The NASDAQ up 1.5%. The small caps doing pretty well today also. The Russell 2000 up 1.33%. In terms of the stocks that we're watching closely at the open, Lyft and Rivian, you know, we just spoke with the CEO of Rivian. Right now they're down 9%, so getting punished pretty badly for a slight miss on revenue and a bigger cash burn than had been anticipated by analysts in our survey. Taking a look at Lyft right now, down 18%. That is rough. Being second to Uber is no good after those earnings come out. Sonali, what are you looking at in terms of, I think, really the consumer that's getting hit?
Absolutely. Some brutal moves in consumer-focused stocks reporting this morning. You have Airbnb now down almost 15%. You can see potentially a record drop down in Airbnb shares today. Also, Disney seeing a drop of more than 3.2%. Both companies showing signs of weakness in the consumer. Airbnb bookings missing, and Disney showing weaknesses in their experiences business. Also watching Supermicrocomputer falling, disappointing gross margins over there, overshadowing an otherwise strong 2025 net sales forecast. Supermicrocomputers now down 12.5%, 13%. Let's take a closer look here with Bloomberg's Abigail Doolittle.
Yes, it is the worst day, Sonali, going back to April 19th. So take a look at this nosedive, down 13%, as you mentioned. It has everything to do with those gross margins coming in at 11.3% versus the estimate, or versus 17.1% a year ago. So basically a 400 bip drop in gross margins. However, that forecast that Sonali was just talking about, let's take a look at the big growth here, because we will see that revenue is really expected to grow. This year, revenue is expected to grow more than 100%. Next year, very strong growth, I think around 70% or so. In terms of the overall AI chip space over the last month or so, though, there's been lots of bumps. Let's check in on a number of these stocks. And, well, we've got lots of red on the screen here. This is pretty interesting, because if we were to have done this about a month or two ago, this would not have been the case. NVIDIA down 14%, AMD down 22%, ARM down 34%. And then, Matt, here is that Supermicrocomputer in this over the last 30 days, down about 36%. Really pretty extraordinary.
Yeah, absolutely. But if you have that kind of exposure to an industry that gets hit so hard, a lot of people think AI is a bursting bubble, Abigail, and the NVIDIA doesn't get punished as much as the smaller players like SMC. Abigail Doolittle, thanks very much for that. Let's talk about whether or not AI is a bubble. Is it sustainable in terms of these levels, valuations, even after the big drop, or especially after the big drop that we've seen? Nancy Tengler joins us, CEO and CIO at Laffer Tengler Investments. Nancy, you all had leaned in pretty hard to this. I know that you lightened up a little bit in terms of your big tech holdings, thankfully, previous to the last few days of drops. But what do you think about the potential of AI? I mean, are we over-investing? Are we going to see ROI?
I think we are, Matt, and thanks so much for having me. You know, I look at the company's CapEx budgets, and I see it a little bit differently than the street does. First of all, these are smart management teams. They're not going to invest billions, tens of billions of dollars in something that they don't think they can monetize. But more importantly, one man's CapEx spending is another man's revenue. So I think you want to be in the right spots clearly, and we can just see that in the consumer space between Uber and Lyft. It matters which companies you own. You know, happily we own Uber and we don't own Lyft, but it doesn't always work out that way, by the way. But I do think you want, if generative AI doesn't work, then the market has much bigger problems because it's really permeating across sectors. I just gave a speech on this at the Money Show in Las Vegas, and the use cases are exploding, and it's not just within technology. I mean, I know most people know that, but it's financials, healthcare, industrials, and so you really need to see this work, and we think it will. Last thing I'll say is, you know, I was managing money in the 1990s, poster child of excess valuation, Cisco Systems, closed out the decade at 100 times earnings. John Chambers, who was the CEO, has said that he believes, and I think he's right, that generative AI is bigger than both cloud computing and the internet combined. So stay tuned. I think we're in early innings.
More on the consumer here, Nancy, because you're seeing Airbnb really drop to record levels. You're watching it drop the most since it went public. And Airbnb, Lyft, these are a generation of companies that went public when interest rates were ultra low and when the consumer was very, very strong, flush with cash, really. Do the dynamics change, or is this just a knee-jerk reaction you're seeing? A lot of fear around that consumer causing these stocks to fall more than they would have if that fear wasn't there.
Yeah, I think you're right, Sonali. I mean, if you look at every company that has just modestly disappointed, I mean, take Microsoft. The disappointment was Azure was growing at 30% versus 32, and the market sold it off. I think the market is looking for an excuse to take these a number of these companies down when they disappoint. I don't think either one of these companies is in dire straits. They are in a different position than the large cap tech companies who are actually benefiting from higher interest rates because of the cash on their balance sheets, just kind of, you know, printing money, if you will, from the interest income. So I think you just want to be adept. Some of these will be buying opportunities, and some of them will be dead money that you want to stay away from for some period of time. Own the industry leaders with the best management teams.
Nancy, you referenced the 1990s. I was there too. You've been in this business for a long time. When you look at these summer swoons, and you think about investors who are in it for the long haul, not, you know, tactically trading, but holding a portfolio for 5, 10, 15 years out, are these always good times to buy?
Yeah, absolutely. We're having a sign made for our office that says volatility is the friend of the long-term investor, because historically, just look the last 3 years. In 2022, it made sense to add to holdings and add risk back into your portfolio, which is what we were doing. 2023, we got another summer swoon in technology and growth stocks in general, and now we're seeing it again. I think, you know, you can't underestimate the power of the hedge funds and the hedgies going to the Hamptons and pulling some of the volume out of the markets and increasing volatility. Then you've got this, you know, the carry trade issue. But at the end of the day, it made sense. I mean, we had some real big pullbacks in the 1990s, but the NASDAQ was up 820-something%, and the Dow and S&P were up about 450% with higher interest rates. So 10-year between 5 and 8%, with higher inflation averaging around 3%, a labor shortage. What we haven't talked about, and what I thought was the bright spot from last week, is productivity. It came in well ahead of expectations at 2.3%. It was revised up, and that's, you know, that put pressure downward on unit labor costs, which will put downward pressure on inflation. Chairman Greenspan understood that. And so let's hope that this Fed does, because you can have, you know, a GDP now of 2.9%, as it was recently revised up to, and you can have growth that is less inflationary than most people would expect.
Nancy, it's worth talking more about the macro. We're talking more about positioning. But another example here that I think is pretty fascinating is you look at a market in search for options. And on the flip side, you see some major pain in some of those consumer-focused stocks. You see Lumen Technologies, after a 90% surge yesterday, another 40% this morning. And I wonder how much money is just flocking to the AI names that work and bursting valuations to a place that maybe are unsustainable.
Yeah, see, I think that's the point, Sonali. I mean, that's what always happens when you have emerging technologies. And we learned that painfully at the end of the 90s when you had, analysts measuring eyeballs instead of earnings. And I think at the end of the day, stocks trade off of earnings. So in the near term, we have all these other, sort of shocks that that drive the short-term returns, but long-term, companies trade off of earnings, and you need to own the companies that are going to survive this. And so, as obvious as it sounds, you want to own Microsoft because they'll buy the competitor that's leading edge. That's and they have leading edge technology themselves. But those are the kind of places where I want to hide. If you think the economy is slowing, and the GDP now number will go up and go down between now and the end of the quarter, but it is slowing. The labor market is softening. You want to own the reliable earners. And if you look at consumer stocks, as you pointed out early, Pepsi, and Procter and Gamble, they have no more pricing power. And their earnings growth is going to be mid-single digits, and they're trading at 21, 24 times next year's earnings. I'd rather own Microsoft that's growing 15, 16% at 31 times earnings, just as an example. So it matters. You want to stay away from the new fractional companies.
Nancy, we thank you so very much for your time. That is Nancy Tengler, CEO and CIO at Laffer Tengler Investments. And it's interesting, Matt, it's not just Lumen that is rising today. You actually have every company in the Philadelphia Semiconductor Index rising this morning. The SOX is up more than the rest of the market, up more than 3%.
Yeah, good breadth today. I noticed 434 stocks are up right now in the S&P 500. So really ripping. This is Bloomberg.
This is Open Interest, and a quick check on stocks this morning, ripping as we've been talking about here. S&P 500 up more than 1.4% with a broad-based jump in most of the stocks in the index. NASDAQ 100 jumping even more, 1.8% higher. Those small and mid caps also seeing some love, Matt, 1.4% higher.
All right, let's get your top calls for you. Some of the analysts' action in focus this morning. First up is Loop Capital Markets cutting Trex to a hold. The outdoor decking company lowering its sales outlook for the full year. The Loop analyst says headwinds are more significant than had been anticipated. Next up is TD Cowen cutting its recommendation on Molson Coors to a hold. The analyst says the beer giant didn't hold on to share gains from last year's Bud boycott, especially considering that shelf space for Molson Coors beverages increased by 13%. They should have taken advantage of that and failed to. Finally, B. Riley is downgrading TripAdvisor to a neutral. The online travel site missing second quarter revenue estimates. The analyst says the disappointing report reflects deterioration in the company's core business. Sonali?
One stock to watch at the open is Disney. The company posted its first ever profit in the streaming department, but it's offsetting sluggish performance at its theme parks, which are seeing moderation in demand. You're seeing Disney shares down almost 3%, and CFO Hugh Johnson spoke earlier on Bloomberg Surveillance.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Madison and Wall principal Brian Wieser joins us. You see the entertainment numbers out there. That's really what's spooking the market a little bit this morning. When it comes to Disney, you have the CFO saying that it's, let's say, somewhat of an aberration, not something more consistent. Bloomberg Intelligence, though, disagrees. Brian, how do you see these numbers playing out?
Yeah. Well, I thought the advertising numbers were certainly very strong, although they had also very, very easy comparables from the year ago period. So it's kind of hard to read that. You may have seen Tegna also just came out with numbers which were probably closer to where the underlying TV business is at -5. And if you think about that, Disney did quite well, all things considered. When we look at the streaming business, they're continuing to grow and make good progress there. I think that the shift to including ad-supported offerings for Disney Plus, obviously really positive. Hulu's doing well. Consumers are willing to spend money on these services. And so I think that's probably, that's the stuff that I'm focusing on. It's a strong business in the long term because they are investing in content. They could be investing more. I think Disney Plus would probably benefit from more of that. But ESPN also is doing quite well. Remarkable numbers from the quarter.
I wonder about the parks business, just because we've seen some eye-popping numbers recently, Brian, in terms of costs. I think I saw a report that a high-end trip with a family of 4 costs $40,000 to Disney World. Are they regretting their price increases, or are they going to hold tight, you know, since at least they're not seeing a decline, right? They're still seeing 2% gains year over year.
Yeah, well, I mean, I don't spend too much time thinking about the travel business, but I think that maybe I could point this out, that consumers are still spending an awful lot of money on services broadly. When I looked at the latest services quarterly survey from the Census Bureau, I mean, it looks like we're going to still see mid to high single-digit growth rates in spending on services. And exactly as Hugh Johnson pointed out, the higher-end consumer is probably driving that. The lower-end consumer is probably not. Now, can Disney parks, see some short-term challenges because there's going to be more spending on travel abroad? It makes sense to me. But the underlying spending patterns in terms of higher spending growth skewed towards higher income consumers, I think, is probably going to help them in the long run.
You know, you think about Disney and the position it's been in the last couple of years, and in this earnings report, they really do tout pretty high up what they're seeing out of ESPN, ESPN Plus, and of course, there are some interesting deals happening in that industry ahead. Do you think that there's still a rationale, Brian, to bring up that conversation about what it would look like if ESPN was spun out of Disney?
And Brian, by the way, is a former investment banker, so like you're pitching these kind of deals, right, Brian?
Well, once upon a time, it does make a ton of sense because the dynamics of sports and sports-related video programming are so different than the rest of the industry. It made a lot of sense in a world where you could tie together access to the distributor to the sports-related product if you wanted the other product. Rather, you want sports, you're going to get all this other stuff you don't want. In this world that's more a la carte, it's a lot harder to tie those things together. Because the cost profile of sports-related programming is just so significant that you will not be able to avoid spending 8% more per year on the underlying sports rights. Whereas with the rest of the content business, those costs can probably go down. I mean, we talk about what an AI-driven content world starts to look like, especially when you look at reality TV and a lot of other programming, not news, not business news, certainly. The profiles of these businesses will look very, very different. So I do think that there is still a significant rationale for ESPN to eventually be spun out.
All right, Brian, great to get your take. Brian Wieser, not only famous for the analysis that he's done in media, but also for his investment banking experience. Great to get some experience and wisdom from you on this earnings report. Coming up, we're going to talk more tech, but less media. Tech-heavy hedge funds lost hundreds of millions of dollars in the recent sell-off. We'll discuss the ones that were hit the hardest next in our Wall Street Beat with Hema Parmar. This is Bloomberg.
Time now for the Wall Street Beat. After the global sell-off took place earlier this week, some of the world's biggest hedge funds lost hundreds of millions of dollars as a result of being in the most popular of tech stocks. But the market turmoil helped Brevan Howard's flagship hedge fund swing to a profit for the first part of the year here. Joining us now is Bloomberg hedge fund reporter Hema Parmar, who's had her eyes all over the industry, and it's been a very volatile year. When you look at Brevan in particular, I think it's an interesting moment for macro funds to be capitalizing on things. They had lost some money earlier this year due to wrong way bets on Fed cuts. How did the turmoil help?
Yeah, so you actually see an example of a fund doing well in this market. They were down before July. Now they're up about 1%. They made about a 2% gain in the past couple days, which is, really good for them. They have been saying since January that the market isn't pricing in enough rate cuts to come, and so they are expecting more to come. And it looks like their bets have helped them.
What's going on at Light Street?
Yeah, so this is a fund that is not winning, down 9% in 1 month of July alone. They may be down more when you look at the turmoil in August. Up 40% for the year, but keep in mind this is a fund that has big bets
40% for the year, including the bad month.
Including the bad month.
Yeah. That's what I was going to say. They did really well before this.
They did, but they're still digging themselves out of 2 years of losses. In 21 and 22, they were down a collective 40%. So, you know, they're trying to dig themselves out of this high watermark. Their biggest position, Nvidia, about 17% of their portfolio as of March. Sizable chunks in these tech stocks, and that can work for you and the market's great, but when you see a really difficult month, it can really backfire.
How about some of these Tiger Cubs? You know, it's interesting to see what's happening at Tiger Co2. They had similar problems, to my understanding, as Light Street. How does this year complicate getting out of that kind of high watermark moment that they're grappling with?
Yes, yeah, a lot of funds had a very difficult couple years and need to try to get out of that hole. And so, you know, every month matters. Every month that you're not making money impacts the year-to-date return, impacts what investors expect, and will impact whether or not they continue to stay in the fund or they give it more time. So, you know, until investors are made whole, the firm is also not charging fees to the full extent. And so that impacts how much they're bringing in terms of expenses and revenue.
Joe, pull up that full screen again of their holdings, because I think it's interesting to look at the fact that they're green check marks on almost every single one of these stocks for almost every single one of these hedge funds.
Yes.
I mean, it's a herd.
Concentration risk you're worried about, too.
Exactly.
Precisely. So, you know, these funds, generally Tiger Cubs, even some that are not, these are their top 10 positions. Their biggest stakes are in these companies, Meta, Amazon, Microsoft, Nvidia. So it's unsurprising that when you see a very difficult month in tech, that you see this pain kind of across the board to different extents.
But why pay 2 and 20 for that? Why don't you just buy the Qs?
You know, there were some funds up. David Einhorn was up, Rentec was up. So let's not throw all the babies out with the bathwater, Matt.
And they're less tech focused too. So they're more healthcare and other things too.
All right, it's interesting because, you know, if you just own the S&P or the Qs over the past 10 or 15 years, you're outperforming any of those hedge funds. So, Hema, great to have you on to talk about the horse race. We've got to do this more often because I think it's pretty fascinating stuff. Hema Parmar covers hedge funds for us on the print side. In terms of what we're seeing in the markets, still green arrows across the board and getting better here. The S&P 500 up 1.4%, the NASDAQ up 1 2/3% almost. We've seen the Russell sort of hovering around that 1 1/3% gain. Coming up in the next hour, MicroStrategy Executive Chairman and co-founder Michael Saylor is going to join us. I will tell you, he likes Bitcoin.
Yeah, he does.
I'm going to say he's going to go long Bitcoin. 10:30 a.m. Join us for that interview. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today. And coming up, dovish signals from the Bank of Japan give fresh legs to the recovery in global stocks. But worries remain. Disappointing earnings reports continue to pile up, with Disney and Airbnb showing real weaknesses in the consumer. And we'll get the view from the C-suite this hour from Resy CEO Pablo Rivero and MicroStrategy's Michael Saylor.
Let's get a check on where the markets are right now. Seeing some decent gains here, 1 2/3% on the S&P 500, and some really good breadth as well. If you take a look at the S&P right now, the move function on your Bloomberg will show you that we have 458 stocks gaining. So almost all of them are up. The NASDAQ gaining 1.9%, almost 2% there. We know that the Russell's up as well. The 10-year yield at 393.73, and Sonali, as you point out, we're looking at 399 right now on the 2-year. Nope, just over 4% now.
Woo, we broke
on the 2-year yield. So investors selling off those treasuries that they were clamoring for on Monday.
But if you're buying that 10-year auction today, you're looking at 393. It might be below 4% for the first time in a while. Now, we're also watching Europe's most valuable company, Novo Nordisk. The stock needs a checkup after reporting disappointing sales of its blockbuster weight loss treatment, Wegovy. The company's CEO spoke with Bloomberg's Francine Lacroix earlier this morning.
The second quarter is a quarter where Wegovy came in a bit short of consensus, and that's linked partly to some adjustments in how we accrue for rebates. So I would really urge investors to not just look at the quarter in isolation, but look at our confidence in the rest of the year and the upgrade we are bringing.
And for more on Novo's quarter, we are joined by Bloomberg Health reporter Madison Muller. We're also going to talk about the competitors here. When you look at the numbers themselves, you look at the competitive pressure, you look at also the relationship to insurance companies and pharmacies here. Does this sell-off seem warranted given those concerns?
Right. The thing is, I mean, the expectations for Novo Nordisk and Eli Lilly are so high, and that's something that we've talked about before. I mean, the margin for error for them is very small. So anytime there's, a competitive pressure, a supply pressure, or they miss estimates, it just affects them a lot. And that's what we were seeing this morning. It's actually a good thing that there is more uptake and that we're seeing more insurers cover the drug. But that also comes with more pricing pressure because of the discounts that are offered, through the pharmacy benefit managers.
So we're not talking about, they're not selling fewer drugs. It's just that their prices are getting compressed, right?
That's
by
part
the
of
pharmacy
it, yeah.
benefits managers.
I mean, the problem for Novo Nordisk right now is they actually they're struggling with supply. I mean, that has been the problem still struggling with supply. As of today, actually, most of the doses of Wegovy are listed as available in the FDA's shortage database, but Novo is having to continue limiting these lower doses, these starting doses of the drugs, because their supply is still so limited.
Can I ask, you cover the drug maker side, but I wonder about the insurer side. I tried desperately to get a hold of some Wegovy. My doctor said, okay, you're 50.
But did they tell you that 1 pint of ice cream was not enough?
A day. No, the problem also is, I'm 50, I'm a little overweight. I'm worried about my heart. I want to live longer. So I feel like it's preventative in some ways, right? We've seen studies that show these drugs are good at staving off heart attack risk. Why don't the insurers want to pay for the drug now rather than pay for my hospital stay when I have a massive coronary arrest later?
You are not going to have a coronary arrest.
Thank you.
Well, that's the argument that the drug makers are making, and that's why they're running all of these studies to prove, without a shadow of a doubt, that these drugs do these things and that they're able to ward off these other health conditions. And we are seeing more insurers covering them, but at the same time, because the drugs are so expensive and because so many people can potentially benefit from them, it's really putting a lot of pressure on these insurers. It's becoming really expensive. So at the same time, we actually are seeing a little bit of a pullback from some insurers who are just saying it's not possible to cover all of these.
How does the competitive pressure stack up, knowing that Eli Lilly is reporting after market today, and also given the not only weight loss potential of this drug, but for all of these firms to really race to figure out what the other treatments are? Novo had announced that they kind of delayed one of their major kind of studies here, didn't they?
Yeah. So Lilly reports tomorrow morning pre-market, and Lilly has actually been their supply situation has been getting better. So it's this interesting dynamic right now of Novo is still struggling with supply, Lilly's is getting better. So I saw some analyst notes this morning wondering whether, that's affecting decisions in the clinic of are people choosing Zepbound because it's just available, and that's a potential benefit for Lilly. When it comes to other drug makers and competition, we do have so many others that are now trying to get into this market. But, Lilly's CEO has said it'll be a few years still because they have to do these late-stage studies to get approval. And so Novo and Lilly still have a huge advantage potentially for years to come because they're so far ahead of this. And we did see Novo delay one of their major studies in heart failure, and they are going to refile for approval next year. Lilly recently had a study in heart failure as well. So it's just, they're neck and neck in terms of studying these drugs and different diseases.
Although Lilly's an outperformer over the longer term. I always pull up the comp screen on the Bloomberg, and it defaults to 5 years, which I think is a nice time period to look at. Novo Nordisk total return 462%, which is not bad, right? But Eli Lilly total return 659%. Unbelievable returns there. Madison, thanks so much for joining us. Madison Muller there talking to us about the GLP-1 makers. We're joined now by Ellen Lee. She's a fundamental portfolio manager at Causeway Capital. And Ellen, I want to get your take on, the effects of these drugs, not only on the makers, but also on, if I look at Pepsi, I'm worried that people are going to buy fewer Fritos here. Do you think about GLP-1s in terms of real market-moving effects?
As of now, as the analyst talked about earlier, I think there are definitely supply chain issues at this point. So I think really determining when wide adoption will happen is the key barometer in which how fast these drugs can hit the demand of the snacking companies and restaurant companies, as well as even beverage companies. So yes, I do think about this risk longer term, but I'm also hearing what Novo or Eli Lilly are doing and also Roche are doing in terms of advancement. But yes, it is a lingering fear. Yet as of right now, the adoption is slow. So we'll have to see. It's still early days to make an assessment of when it will start to significantly impact, if ever, these snacking companies.
One question I have about the pharma industry is it's really easy to latch on to the allure of these weight loss treatments. But at the end of the day, it's such a specific and small part of the overall healthcare story, a sector that a lot of investors are gaining increasing interest in this particular environment. How do you navigate the sector?
I think, for us at Causeway, when we do bottom-up research, we're not just looking at the phenomenon of, meeting your, colleague or your friend who's just taken Wegovy and lost 50 pounds. We are actually looking at the supply chain, meaning, okay, is there a supply capacity there? And then we're also looking at the insurance companies to see, what the affordability will be like. So you have to look at it from the manufacturer all the way to the consumer and not ignore the supply chain issues that gets in the middle in terms of accessibility. And that's sort of key to understand, the adoption rate in the long term.
These stocks are still big high flyers, and I know that you're looking for more value, right, Ellen? At least if I look at the stocks that you're interested in, Kering, for example, it's a luxury goods maker, but it's been discounted by the market on concerns about a recession. What do you think about the luxury goods market right now?
You're absolutely right. Luxury goods market is tough. Obviously, they had their day in the sun a few years ago with COVID and so much discretionary income. I think in the current market, as you mentioned earlier, markets have been very strong, and there are reasons to be optimistic about a soft landing, and also on the converse, be pessimistic about a hard landing. But we're looking at the company's valuation, and to try to mitigate for what could happen in the macro environment, we're looking for opportunities where the downturn is already priced in. So in such case, we believe stocks like Kering, even though their earnings could fall during a downturn, much of that is already discounted. And therefore, that gives us margin of safety in a scenario where there is a downturn. And also, if you look at the valuation gap between companies like Kering versus LVMH, the margin of safety is there for us to believe that, when Gucci, the brand, does recover with its new products that's hitting the stores today, there is plenty of upside.
Ellen, we have to leave it there. That is Ellen Lee of Causeway Capital. We're going to get a look at the stocks moving this hour. Of course, a lot of things under the surface here. Abigail Doolittle is here to join us. Abby?
There certainly are, Sonali. Let's start off with the shares of Fortinet absolutely soaring, up more than 24%, heading to the best day since 2009. This after a massive beat. They put up 57 cents in adjusted earnings. That represents a greater than 40% adjusted earnings beat. 2.2% revenue beat, margins good, billings growth good, investors really liking this stock. Let's turn to the shares of Dell. Now, this is not an earnings report, but this is interesting because it could give us a sense on the global IT spend. Shares down nearly 4% right now. They're laying off some managers and sales staff to, quote unquote, get leaner amid a modernization. But again, when you see a company like this making these sorts of cost-cutting moves, you have to wonder, does that represent something from their customers? And then finally, let's take a look at some of the other tech names on the day. We have continued rebound. Importantly, Apple's now joining in, up 2.5%. Microsoft, Meta, NVIDIA higher. What's interesting here, Matt, is some of these stocks have what's called a quote-unquote V-bottom, a bottoming process process that can take stocks sharply higher. Others don't. What they all share, though, is not so good-looking weekly and monthly charts, suggesting that any sort of rebound that we're seeing right now, it may not last for too long.
All right, always great to get the fundamentals from you, Abby. Thanks so much for doing that. Abigail Doolittle looking at some of the big cap tech stocks there. Coming up, the Harris-Walz campaign says it raised more than $20 million in the past 24 hours as it heads to multiple battleground states today. Details on the campaign trail next and the state of the race. This is Bloomberg. All right, let's get to high interest to look at what's making headlines around the world. Steve Mnuchin says it's time to kill his own creation, the 20-year Treasury bond that's costing taxpayers a lot of money. The Treasury reintroduced the 20-year bond in monthly auctions 4 years ago, but it fell flat with investors. U.S. 30-year mortgage rates plunged last week by the most in 2 years, reaching their lowest level since May of 2023. The drop has sparked a surge in refinancing applications, with one index jumping last week to a 2-year high. And Vice President Kamala Harris is stepping up her efforts to bring rank-and-file union members in swing states back to the Democratic fold. She's being joined by her newly named running mate, Minnesota Governor Tim Walz, at rallies in Michigan, Wisconsin, and with the United Auto Workers President Shawn Fain expected to join them in Detroit. Sonali?
Let's now discuss the state of the race with Bloomberg's Anne-Marie Horadern, of course, the chief political correspondent over here at Bloomberg Television. And you look at her getting on the road here. What do you expect?
So I think what they're going to do is similar to what we heard last night. This is really them going out and getting some excitement. This is a brand new ticket, very different than where we were with Biden at the top of the ticket. It's obviously a much younger ticket. There's an enormous amount of energy, if you watched last night in that room and speaking to some of the reporters who were in that room, about the excitement that this is just new and fresh. So they have to go out and talk about what they care about. They're going to lean heavily on abortion rights, if you heard that from yesterday. And you also see them trying to take this different tone. It's more of a positive tone. They don't want to look back, except to saying that we're not going to go back there. They are trying to take a more upbeat, positive tone, leaning into the fact that they are fresh. What is also very important is when you look at the Marist poll that was done before she selected Tim Walz, the governor of Minnesota, potentially now those numbers will change a little bit, but more than 70% of Americans do not know who this guy is. So he also needs to introduce himself to the American people, and I expect a lot of that is going to be what they use these next few days for.
The Republicans will bring up the protests from the pandemic era, the Black Lives Matters protests. How vulnerable is Walz when it comes to that? And then Israel hawks are unhappy that Shapiro wasn't picked. How hawkish will Shapiro Walz be in the fight against Hamas in Palestine?
So Governor Shapiro came out last night because it was in his backyard. It was in Philadelphia. It came down to him and Walz. The New York Times just ran a story about 40 minutes ago talking about the fact that Governor Shapiro, according to their sources, had called back, asking a little bit more about what his role would be. Some of them actually equate him to maybe a fresh kind of orator, the way Obama was, maybe taking the shine away from Kamala Harris, although there were definitely calls that he was potentially too much of an Israeli hawk for this ticket, which is why the Trump campaign didn't want him for that reason, and also for the fact that he would potentially just shore up Pennsylvania in full. When it comes to Walz and how they're going to try to pigeonhole him, as I said, more than 70% of Americans, according to this recent poll, don't know who he is. So it's a race to try to define him. We know what the Harris campaign is going to say about him. Republicans are going to really want to focus on two things. You mentioned what happened with the Black Lives Matters protests. What we saw in the state when he was governor, there's a lot of criticism that he didn't bring in the National Guard early enough when there was the upheaval following the tragic death of George Floyd in 2020. The other area of concern that Republicans are going to want to talk about is social concerns, things like gender reaffirming and the fact that they are this refuge state. And potentially, if your child goes there, can you get a court injunction to bring your child home? These are going to be areas where they're going to try to say he is too left and he is too progressives. If you look at the Wall Street Journal editorial board today, they struck a similar tone that we discussed yesterday off of Terry Haynes's note, which is the fact that she doubled down on the progressives. You see the Democrats and the Republicans both doubling down on their base.
You know, one thing I think that's kind of interesting, you think about the social implications, but also the business implications. And the idea that you're bringing on another person that leans left, there are interesting dynamics here. Yes, he is kind of pro-union here, has union support. He did also veto a bill that would have set minimum wages for gig economy workers, Uber, Lyft drivers, kind of from a threat from Uber here. But interestingly enough, with Tony West also really working more on the Harris campaign, I'm wondering if there are signs of light here in terms of how they might approach the business community.
Well, I think the big thing what's going to happen next year, and even heard senators call it this, it's tax Armageddon. They have to come to a tax deal because the Trump-era tax cuts come to an end. Now, if you look at Governor Walz's policy when he was Congressman Walz, it's very different. He actually voted at one point against Democrats to extend the George W. Bush tax cuts, but at other times he voted with his Democrats. He was way more down the center. One thing for sure, though, when it comes to tax policy, potentially do we see the lowering of the corporate tax rate? Well, the White House is only one part of this. We really need to see the composition of Congress, and that we're not going to know till November 6th.
Absolutely fascinating.
Yeah, thanks so much for joining us. Emery Horton here talking politics.
Want to quickly actually
check
on
something? Did you want to look at the 2-year?
I sure did, because I am just absolutely stunned today by the movements in the bond market here. If you take a look, we are flirting with 4% now, firmly at 4%. The 2-year was as low as 364 earlier in the week in the midst of the panic. That big rush into the bond market actually now pretty much entirely reversed, though still about 100 basis points of cuts priced into the markets, Matt. Stick with us. This is Bloomberg. And it's time now for Social Climbers, the companies making waves this morning. And first up, Shopify riding highs after beating second quarter earnings expectations. The Canadian company's AI-powered tools are pulling in more merchants to its platform. And then up, Lumen Technologies extending gains after raising its forecast for free cash flow. The telecom company said AI demand is driving billions of dollars in new business. You have Lumen now up more than 26% after a rally yesterday as well. Finally, Intel reportedly passing up a $1 billion investment in OpenAI in 2018 that would have yielded the chip giant a 15% stake in the company. At the time, Intel decided against the deal because then CEO Bob Swan didn't think generative AI models would make it into market in the near future. Intel is not commenting on the report. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, Rivian sees flat production this year, but its CEO, RJ Scaringe, expects output to grow in 2025. Ed Ludlow and I spoke with Scaringe in the last hour on his deal with Volkswagen.
The Volkswagen partnership is something we're really excited about, but the focus of this is around leveraging our network architecture, our topology of computers, topology of electronic control units, the ECUs in the vehicle, and then, of course, our software stack. It does open the door to other types of partnership and activities we could be doing with Volkswagen Group, but to date, the core focus, the singular focus, is around our software and electronics technology.
All right, so he has been using that software technology and those ECUs to update their core product. That is the R1S, their core SUV product, I should say, at Rivian. We're joined now by Bloomberg's Hannah Elliott. She is also my co-host on the Hot Pursuit podcast, which, if you like cars, you should listen to. And she just recently got out of one of the updated R1S trucks. Hannah, you got a story out on the new, I guess, improved Rivian. What do you think?
Good morning, and I will say you are right. It is improved. I drove the R1T truck in 2021, and at the time I thought it was pretty cool. I had some things to work out. This second generation R1 platform, I drove the R1S, the SUV, really does have some notable improvements. I think the biggest thing is the software, the infotainment, all of the electronic systems inside are really, in my experience, were flawless. And that was not the case before. We have just so much more capability inside with connectivity, with entertainment, navigation, that sort of thing. So that's a really big improvement. And then also we have a nice extras. We've got the panoramic sunroof that now goes to dark if you want. We've got heated and ventilated seats. We've got a lot more trappings of luxury. So yeah, I would say it's improved for sure.
How does this compare to the other big luxury family vehicles you could get? I want a truck where I can put my kids in the back seat. You've got, you know, to deal with your dogs and Magnus's beard. Is it a great, big, expensive family truckster?
Yes, it is a great, big, expensive family truck. The one that I drove was the Performance Dual Max, which starts at about $95,000, and with the options that were included in the one that I drove, it was over $100,000. So yeah, it fits 7 people. It has a lot of capability. I love that the seats lay completely flat all across the back. So there's a lot of practicality, but it's expensive. It's more expensive than like Kia's EV9, which I know you and I both love. It's actually more expensive than the Cybertruck, which slightly different vehicle because it's a truck versus an SUV, but very similar too in size. So yeah, it's expensive, it's practical, it's expensive.
All right, Hannah, thanks very much. We'll check out the story on Bloomberg.com. Hannah Elliott is the co-host of Hot Pursuit, Bloomberg's weekly podcast for car lovers. You can check it out on the Bloomberg Terminal or wherever you get your podcasts.
This is Bloomberg Open Interest. You gotta love a day with divergence. We're gonna get a check on these markets with Bloomberg's Abigail Doolittle as stocks are climbing around the world.
Stocks are climbing around the world, but we still have that Monday to think about, and actually the day is leading into Monday. But on the week right now, we do have the S&P 500 down about 0.8%, not showing the big drop. But again, on Monday, down more than 3%. Some stocks trying to counteract this, though, and maybe bring the S&P 500 and other indexes higher. Take a look at Lumen Technologies, up 25%, massive free cash flow forecast. The communication companies does have a 13% short interest. That could help to explain it. In addition, this stock, not for the faint of heart, up 246% this year. Yesterday alone, up 93% in anticipation of that strong quarter. Instacart up just 0.8% earlier, higher. They did put up a earnings beat and also a sales beat. Investors mainly liking that, plus a good earnings outlook. TripAdvisor, though, not so much. Take a look at this. Shares down 13%, revenue missed, and in particular, Experience and Dining Week. Reddit down 5.5%. Strong results, but a mixed guide. So some winners, some laggards in terms of earnings. Let's take a look at 2 big movers to the downside, however. Airbnb down 15.2%, the worst day ever since IPOing just a few years ago. There was a weak outlook, a guide. This is, again, the worst day ever. And then Disney down 1.8%. Overall, the quarter was fine, but Parks Week really highlighting, Matt, these signs that we're receiving from multiple companies that consumers are starting to get a little bit price fatigue, spending fatigue, and are tightening down the wallets a little bit.
Yeah, absolutely. The consumers, the visitors to the parks are up, but only 2%. That's weak growth. Instead, they're staying home and ordering, you know, Disney Plus or watching stuff on Hulu and ESPN. Abigail, thanks very much for that. Abigail Doolittle talking to us about the difficulty that the consumer's in, as evidenced through earnings. We see that in TripAdvisor with bookings weaker than expected. Same is true with Airbnb and Disney Parks. Let's talk about that right now with Resy. It's a restaurant platform that you probably use as well. Sonali and I both do. Logging its 600 millionth reservation just last month. Joining us now is the CEO, Pablo Rivero. Pablo, it's great to have you on at this time when we see it looks like the consumer isn't going out as much, not booking an Airbnb, not going to Disney World, and staying home instead. Do you see that mirrored in your platform?
Oh, well, first of all, thank you for having me. I'm very excited to be here. What we're seeing is consistent demand for dining. People are still going out, right, trying to find that human connection with people, right, and dining table is a perfect space for that. Our results show that dining demand has been consistent quarter over quarter.
But is it divergent? Are you seeing people start to trade down on restaurants? Are you seeing the kind of luxury end hold up and kind of the bottom range hold up?
Well, it's a neighborhood by neighborhood story, right? Restaurants are the heart of that community, of that neighborhood. So you do see that some restaurants, right, can be hurting by higher prices, inflation, then rent, and so on. But at the same time, you see new demand, new concept, right, going into the high end of the restaurants as well as casual restaurants.
But if you look at the graph of, reservations over time, is the slope still up and to the right? Is it convex?
It is city by city story, right? So we do have stable across the macro environment, across the United States, but every city has a different story. Any neighborhood has a different story. But demand and spend is still there. Just last year, American Express reported $100 billion of spend on dining, right? Which is one of the highest categories for car members. It is a passion area. We do see diners still going out and finding that opportunity for that human connection on the table.
One thing I'm wondering about, strategy-wise for you, you have this app where you touch millions of consumers. You have this kind of relationship with Amex. They acquired you. What does this mean about your plans moving forward? Do you think Resy can be an app where you offer delivery as well?
That is an interesting concept that we're always looking into, right? How can we add more value to the restaurant and to the consumer? Right? So there are multiple options. We're trying to really drive demand to restaurants. Just recently, we just announced with Amex, which is our parent company, a new Resy credit on some of our products, like the Gold Card and the Delta Reserve Card, right? So we're incentivizing people to go out and dine at these Resy restaurants because dining is an extremely strong passion area for car members.
New York City is about to start to clear out the stalls that restaurant owners put up during the pandemic, and that's going to mean fewer tables. I expect higher demand. It's going to be harder to get into the most popular restaurants. Is that good for you when it's harder to get in? Do people tend to use your app more, or do you like to see a lot of space, a lot of capacity?
We look for ways for people to discover that next restaurant, right? Like neighborhood gem that you might not know of, right? So we invest a lot in discovery. We invest a lot in driving more channels and marketing activities for restaurants to connect with those users. And those restaurants that join our platform are now part of this Resy network where they can also enjoy that incentive for car members to go and spend. And so always finding ways for restaurants to be discovered and to connect with new car members and Resy diners.
What about technology here, too? We're getting an IB from a customer, and is it true here that the Resy app is more available on Apple phones versus Android? Do you have an Android plan moving forward?
Yeah, so today it's available on iOS, and it's also available on web. We're working on relaunching an Android app, and that's on the roadmap for the next couple of months.
Is that because, is iOS a more important consideration because that's a wealthier consumer and more likely to be using your app? Why didn't you do an Android app first?
We wanted to make sure that we had parity between the apps, and we're trying to build that back up. We used to have an Android app. The consumer needs have evolved, and we have introduced a number of new features on that app, and we want to make sure that when we release the Android app, it's just as great as the iOS one.
As Sonali mentioned, you are owned by American Express, and you've got, I think, a new promotion now for Gold Card holders. How important are those kind of promotions? When people are scrolling through what they can get with their whatever card they have, do they click and actually use it? Do you see follow through on that?
We see great uptake on that credit. So the way that it works is American Express is really focused on surrounding our payment products with membership services, whether it's travel, dining, and entertainment, and the connection with Resy is always important. Again, driving back demand to restaurants. So every card member on the Gold Card or multiple Delta cards enjoy that Resy credit. All they have to do is go onto their app, activate that credit, and every time that you dine at a Resy restaurant, that transaction will be eligible for that credit.
Fun fact, Matt, you have JP Morgan owning The Infatuation, Amex owning Resy. Clearly, this restaurant, eating, dining, fine experience market is a big deal for the big financial companies. You've been owned by Amex for 5 years now. Where does this go from here? Ultimately, they like you because they have more offerings to give their customers, but what do they give you?
Yeah, dining has been a passion area for American Express for decades, right? Our car members are definitely, going out, trying restaurants, and really enjoying that dining experience. We are able to connect our restaurants with millions of car members through American Express channels, and that's demand back to the restaurants. That's revenue that goes back to the restaurants. The American Express car member, on average, spends more on dining than the non-Amex car member, and that's revenue that goes directly to these small businesses, right? And we want to help them thrive with it.
Pablo, we have to leave it there. That is Pablo Rivero of Resy, of course, the CEO there, in a very complicated market for the consumer. But they are, of course, still eating. Now, let's get a check on the markets here, because they are, of course, ripping right now. You are seeing some weaknesses in some single-name stocks that had reporting earnings overnight and this morning. Those consumer weaknesses still concern to market investors, but not in the technology sector nearly as much. You look at today, 1.5% higher. Philadelphia Semiconductor separately also riding higher on the day. Very interested in the bond market here because you're seeing yields rising 3.93 on the 10-year and flirting with 4% on the 2.
We are seeing a little bit of fade in terms of this buy, because you had the SOX index, I'm looking now, up 3.75% at one point. And as you mentioned, every member was rising. Now it's only up 1.57%. So you're seeing the market give back a little bit of those gains earlier, but I do think it's interesting that you're finally seeing a little bit of divergence here.
Do you remember Monday? Feels like a year ago.
It does feel like a long time ago, but we had, real breadth to the downside there. And today we had real breadth to the upside. On the other hand, it's not quite as wide as it was. We were looking at 458 gainers. Now we're looking at 438 gainers. So not quite the strength that we saw in the first half hour of trade.
You know what has gotten stronger since Monday is Bitcoin. MicroStrategy owns 250,000 Bitcoin with an average cost of $36,000. We're going to discuss the notion of Bitcoin being a hedge against traditional markets. Some of that seemed to break down, but we're going to talk about it with co-founder Michael Saylor. Stick with us. That's next. This is Bloomberg. We're turning now to the crypto world because there's a notion there that Bitcoin is a hedge against the swings in traditional assets, but that seems to be breaking down. Bringing up a chart here just to show you the volatility over the last couple of months here. Gold has held stable, but Bitcoin has swung quite wildly around it, though the returns are similar in the past month. We're going to talk more about this, the rationale, all of it, with Michael Saylor, co-founder and executive chairman of MicroStrategy, the largest public corporate holder of Bitcoin. And Michael, first I want to ask you, in the last couple of days, you did see for a moment there Bitcoin fall below that $50,000 level. I do understand that MicroStrategy acquired an additional 169 Bitcoin for just over $11 million in July. But when you see that dip below 50,000, do you dive right in, and to what degree?
We're always buying Bitcoin quarter by quarter by quarter. It's a long-term strategy. But the most important point for people to understand is that Bitcoin volatility is a feature. It's not a bug. The volatility creates tens of billions of dollars of credit and liquidity at all times, everywhere, to everyone in the world in the short term. But over the long term, that volatility is driving superior asset performance and durability. So it's volatile because it's functional. The other markets are all closed and they're crippled by the physics and the politics of the asset.
Isn't it a problem when a store of value, if someone wants to use Bitcoin as a store of value, can lose 10 or 20% over a couple of trading sessions?
The reason it moves is because it's functional. It's digital capital, and it's superior to physical capital or financial capital. Bitcoin's a capital investment you can hold for decades that a corporation, competitor, counterparty, or a country can't take away from you. So it'll create generational wealth for your family, your corporation, or your country. You can liquidate it at any amount, anytime, anywhere in the world, or you can hold it for any amount of time without active management or business acumen. So yeah, it's volatile, but it's so superior to every other option that you have for long-term capital management that I actually think the world is just waking up to discover this virtue.
Michael, I still feel the need to really understand the psychology of these pullbacks, because at some point it still matters the price you buy into Bitcoin at. How much are you willing to put to work when you see those dips? What types of dips do you look for when you put more money to work in it?
You know, we look at Bitcoin as cyber Manhattan. So there's never a bad time to buy up scarce, desirable real estate in the greatest city in North America. There's never a bad time to buy Bitcoin. So we will just generally acquire it. whenever we have cash, whenever we can raise money in the capital markets, whenever we see the opportunity, I think timing the market is almost impossible for the mere mortal. It's time in the market that matters.
Another question I have for you, too, is even beyond MicroStrategy, how do you hold Bitcoin personally? Do you have a significant personal stack in addition to what you own through MicroStrategy and a MicroStrategy stock?
Yeah, I do have significant personal Bitcoin holdings. I think about 4 years ago, I tweeted that I have 17,732 Bitcoin. I haven't sold any Bitcoin. I continue to acquire more Bitcoin. And I think it's a great capital investment asset for an individual, a family, an institution, a corporation, or a country. And I can't see a better place to put my money.
How much do you personally own today?
At least that much.
That's a lot. 17,000 is a lot. I was talking yesterday, Michael, to a young journalist, Andrew Chow. He's written a book called Cryptomania, Hype, Hope, and the Fall of FTX's billion-dollar fintech empire. He seems more convinced by Ethereum and the proof of stake method because he's so concerned about the climate and the environment. And a lot of younger people see it this way, that proof of work just takes too much power and is bad for the world. How do you respond to those concerns?
There are hundreds of thousands of investments that people can make, and I don't opine on any particular real estate, equity, or crypto investment. Bitcoin is special because it is literally the most powerful computer network in the world. It's the most powerful. It's got the most electrical power. It's got the most computer power. It's got the most economic power. It's got the most political power. The fact that it runs on 17 gigawatts or more of electricity means it's got more power than the United States Navy. That makes it nation-state resistant and nuclear hardened. So my view is if you're going to put away billions of dollars for decades, you're going to want a very powerful crypto network to defend it. And there really is no second best.
But it sounds like that much power generation is going to lead to, a higher global temperature, melting ice caps and rising seas. Like, when can it get carbon neutral?
That's a silly observation. People have been saying that for 5 years. Bitcoin's not boiling the ocean. It's like 10, 15 basis points of the world's energy usage. So it's de minimis compared to everything else. 30% of the energy in the world is wasted from some other source. So that it's just guerrilla marketing and I think largely irrelevant and debunked at this point in time.
Michael, one thing I'm wondering about is, have you spoken to former President Trump? He's been talking about this idea of what it would look like for the U.S. to have a reserve of Bitcoin. Of course, the U.S. holds some Bitcoin through Bitcoin that has been seized. But what do you think about this broader idea more largely? Have you spoken to the former president about it? I know you have.
The future is digital. There's a race to own cyberspace. And we saw an entire set of politicians waking up to this. Senator Lummis has offered the strategic Bitcoin reserve legislation, and that's our Louisiana Purchase moment. Donald Trump has said, we won't sell our Bitcoin. And that makes BTC the apex property of the United States. The only thing that the nation won't sell are its national parks, its nuclear weapons, and its Bitcoin. I think that the conversation has shifted, and every politician in the world is starting to realize that Bitcoin's the most desirable property in cyberspace. It's the future.
Back in 2013, Michael, when Bitcoin was marching up towards 1,000, we started reporting on it for the first time, and I actually spent 2 weeks living only on Bitcoin, using it to buy gas and beers at a bar down here and groceries at a place in Greenpoint. I bought my first one for $800, my second one for $600, and now I wish I hadn't spent them. Is there going to be a time when we actually use Bitcoin as a transactional, currency without regretting it so much later on?
I think if your grandfather owned a building in the middle of Manhattan and they sold it to buy a cup of coffee or some ice cream, you would have regretted that too. Yeah. half of the wealth in the world is just long-term capital. Call it $400 or $500 trillion. People just want to keep their wealth. They want to hold their money for decades or generations. Bitcoin is capital. And if you think of it as capital, the most desirable capital in cyberspace, then the right way to consider it is the same way as if your family owned a sports team or a trophy asset or a Da Vinci painting or a building or all the land in Palm Beach. You would hold it as long as you possibly could. You would finance it, and you want to buy a cup of coffee with it, borrow some money from a bank, spend dollars, spend pesos, spend euros, but keep the most desirable property in the universe.
All right, Michael, thanks so much for joining us. Michael Saylor is MicroStrategy Executive Chairman and co-founder. He owns at least 17,000 Bitcoin. And of course, MicroStrategy always continues to add to its giant Bitcoin pile. We have some breaking news now, updates on efforts for an Israel-Hamas ceasefire. U.S. National Security Council spokesman John Kirby is speaking to reporters, and he just said, quote, "We are as close as we've ever been to a ceasefire between Israel and Hamas since, obviously, October 7th. A note in terms of Hamas, yesterday named Yahya Sinwar as its political chief, who is one of the key masterminds of the October 7th attack. We'll continue to bring you any developments there. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for our trading diary, what you need to be watching this week. We're going to get U.S. consumer credit numbers this afternoon, so pay attention to the EcoGo function on your terminal. Earnings from Robinhood and Warner Brothers Discovery after the bell.
And we're going to talk to the CEO of Robinhood tomorrow as well. We're also going to get tomorrow morning earnings from pharma giant Eli Lilly and economic data, including initial jobless claims. That will certainly be one to watch. We will also hear from Richmond Fed President Tom Barkin at 3 p.m. Eastern Time. Let's go check on these markets, Matt. They've been interesting this morning. Of course, we've seen a pretty strong bid in the market, 1.5% higher in the S&P 500, 1.8% higher on the NASDAQ 100. We had some serious breath, but as you've been pointing out, it has been wavering a little bit throughout the morning.
Still pretty strong, though. Right now I'm looking at the move function on the terminal. 444 stocks up, 57 stocks down. So that's real breadth in this rally. 1.5% added to the 1% we got yesterday. Still doesn't make back the 3% that you lost on Monday. But we're back at 53.18 on the S&P 500, and we're seeing bigger gains in the tech stocks. As you see there, the NASDAQ is up 1.8%, and as you've been pointing out, the SOX index is a gainer as well. It was up almost 4% a little bit earlier. Right now, the SOX index is gaining 2.25%.
A lot of red on the screen. Airbnb, Lyft, both still down more than 12%. A lot of worries about that consumer. Disney only down now about 1.4%. Novo Nordisk down more than 6.4% in Denmark, of course. And a tough day there for some stocks, but a better day for the market. Looks like the rotation trade is out of bonds and into equities.
Yeah, I think it's really interesting that you're seeing all of this kind of disappointing news on the consumer, not booking as much at Airbnb as expected, not going to Disney parks as much as expected, not on TripAdvisor as much as expected. Coming up on Open Interest, join us for the C-Suite interview. As Sonali said, Robinhood CEO Vlad Tenev joins us tomorrow.